Welcome back, traders. Today, we're diving into something unique and revolutionary. A strategy that will change how you see the markets. It's called the 7-1-4 method. This approach shifts the focus to time itself, offering a whole new perspective on market dynamics. And before we dive in, I want to give a big shout out to the brilliant mind behind this strategy, Mashaya. Let's break it down and uncover the power of time in trading. Alright, before we get into the 7-1-4 method, let's clear up something super important, time zones. Now, in South Africa, we operate in UTC +2. But MetaTrader 5, the platform most of us use, runs on GMT +0. That's a 2-hour difference. And trust me, if you're not careful, it can throw off your entire strategy. So here's the deal. No matter where you're trading from, the trick is to sync your local time with GMT. Just check your current offset, whether it's +2, -5, or +8, and adjust accordingly. It's like making sure you don't show up late for a date with the markets. Let's get this time game on point so we can crush it with the 7-1-4 method. Alright, let's dive into the basics of the strategy. First things first, if you're a swing trader, I've got to break it to you. This is a scalping strategy. We make the money, and we are out, quick and clean. So to get started, switch your chart to the 5 minutes time frame. Next, you need to draw a vertical line at exactly 1 p.m. Now, as we discussed earlier, my local time is GMT +2, which is 2 hours ahead of MetaTrader's GMT +0. So for me, that means drawing the line at 11 o'clock on the platform, which is equal to 1 p.m. local time. Make sure you adjust for your own time zone too. Trust me, this step is key for getting the strategy right. Let's keep going. So once you've drawn your vertical line at exactly 1 p.m. South African time, the next step is simple. Wait and observe price movement until 2 p.m. You're basically just watching how price behaves for that 1 hour. Now, here's where you need to pay close attention. If price moves upward from 1 to 2 p.m., then we're looking for selling opportunities. It is that straightforward. And on the flip side, if price starts by moving downward, then we're going to look for buying opportunities. Alright, let's take a look at another example to solidify our understanding. Before we dive into more practical examples, let's pause for a moment and take a look at this screenshot to better understand the time zones. Now, focus down here. As you can see, 11 a.m. GMT is the same as 1 p.m. South African Standard Time. If you're watching from another part of the world, make sure to check the GMT conversion to your local standard time. This step is super important, so take a moment to get it right. It sets the foundation for trading this strategy successfully. Alright, let's move on. Let's look at this example. I know all this time zone talk can get a little confusing, but don't worry, I've got you covered. To make it easier for everyone, I've decided to use TradingView. First, change your time zone to UTC +2, just like I've done here. Easy, right? Now let's shift our focus to the real chart. Here, I've already drawn my vertical lines for exactly at 1 p.m. and 2 p.m. Simple enough. Now, check this out. Price has been pushing to the upside since 1 p.m. That's pretty clear, right? And as we discussed, if price starts by going up, we're looking to sell the reversal. Remember, this is a scalping strategy. In this example, you can set your take profit at this previous low right here. Quick and effective. Let's move on to another example to solidify this. Same routine. First, mark 1 p.m. with a vertical line and observe how the price moves. In this example, the price pushes to the upside. And you know what that means? We're on the lookout for selling opportunities. Now, we can target this low down here as our take profit. Simple, right? But here's the million-dollar question. When do I actually enter the market? Well, for me, it's all about confluences. Think of it like preparing a good meal. You need the right ingredients. Your supply and demand zones are the main dish, support and resistance levels are the side, And then we sprinkle in some fair value gaps and order blocks as the seasoning. Now, what does this mean exactly? You need to look to your left and use all the entry triggers the market gives you. In this example, we notice this major level of structure up here. Why is this a major structure? Because this level became both the support and resistance, making it a very strong level, where price is likely to reverse from. And as we can see from this example, price was rejected from this major level. If used correctly, these elements turn this strategy into a masterpiece. But let's be realistic. Setups like these do not happen every day. Alright, let's look at an example where the market completely went against us. As usual, we've got our vertical line at 1 p.m. After observing price for a while, we noticed it was bullish from 1 p.m. Naturally, we anticipated selling the market. But surprise, price just kept pushing to the upside. Now, from experience, we probably would have placed our sell orders around this resistance level here, where price had rejected multiple times. It seemed like a solid plan. But here's the truth. Even the best-looking setups don't always lead to winning trades. As traders, this is something we have to accept. Losses are part of the game. The real key is using proper risk management to ensure the market doesn't wipe you out completely. Stay disciplined, protect your capital, and live to trade another day. So this is the current price of gold on the 18th of November. Looks like price is pushing to the upside. And we can see it recently rejected this level right here. This would be a great area to start looking for selling opportunities if price reaches it again. Now, notice something interesting. The market has rejected this area twice already, creating a liquidity pool. What does that mean? It means that if price sweeps the liquidity above these equal highs and taps into the supply zone just above, it could set us up for a really nice selling opportunity. Patience is key here. Let's see if price gives us the confirmation we're looking for. Now let's take a look at the current price of Nasdaq. As we can clearly see, price has been bearish since 1 p.m., which means we're now anticipating buying opportunities. Down here, we spot a previous support level, and price has already tapped into it. Based on this, we expect the level to hold as support and push the price to the upside. So here's the plan. We place a buy orders with a stop loss just a few pips below the level to protect our trade. Then we wait patiently for the market to play out. Remember, in trading, patience is just as important as the setup. For our next pair, we're looking at US dollar to Japanese yen in real time. Now, we can see that price has been bullish since 1 p.m. So, as always, we're on the lookout for selling opportunities. Up here, I notice a minor reaction at this level, which I'd use as my entry trigger to enter a sell. It's subtle, but it gives us just enough confirmation to take the trade. Let's see how this setup unfolds. Remember, it's all about waiting for the market to show us the way. And that's it for today, traders. We've covered how the 714 method works, tackled some real-life examples, and even learned how to handle setups that don't go our way. Remember, no strategy is perfect, but with proper risk management and patience, you'll be well on your way to mastering this approach. If you found this video helpful, don't forget to give it a thumbs up, share it with your fellow traders, and hit that subscribe button for more content like this. And hey, drop a comment below to let me know what you think. Or if you've tried the strategy yourself, I'd love to hear your feedback. Until next time, stay disciplined, stay sharp, and happy trading.